Hello, everyone. Good afternoon. Thank you so much for joining us for our February Lunch and Learn webinar. We will be hosting these webinars on the last Wednesday of every month at 12 p.m. during your lunchtime for 30 minutes, and we look forward to you joining us in the future. Today, Graham will be speaking for about 15 to 20 minutes on timely topics today, and then he will take questions and answers at the end of the call. During the call, if you have questions to write in there, just go into your chat box there, and there's a Q&A section that you can type your questions, and we will try to get to all of them at the end. Also, during this time, Graham's calendar will be popping up at different times, and you can go in there during the webinar and you can click on the calendar and you can go ahead and set a meeting if you want to talk to Graham at a later date. So if you have any questions, please type them in the Q&A for the end of the call. And right now, I'm going to turn it over to Graham.
Hopefully everyone can see and hear me okay. Technology is working, hopefully well during this lunch and learn. I want to thank everyone for being on the call. So today I'm pretty excited. I'm going to be introducing a bit of an article that was written from an analyst that I follow pretty closely from the Loophole Group. And I want to give them credit for this when credit's due. I just think it's bringing up some really interesting points because it is so easy to get very negative on this market. And sometimes we forget, or let's put it this way, we see the forest for the trees, right? Or we don't see the forest for the trees. And sometimes we just need to kind of step back and realize there could be certain puts, things that would buoy the market or support the market that could help protect it from a more dramatic pullback or what we would call a bear market cycle that we think, or at least Jim and his team are pointing out. And I have to agree on. Now, this does not mean that we're not going to get volatility. Of course, we're going to get volatility. You've been in the game, you've been investing. If you haven't, make sure you hit my calendar that just popped up below, and I'll go over this article, your account. If you're new to the call today, thank you for joining, and I'll sit down and go over your goals, objectives, and what we mean by all this, and see if there are some areas that we can address for you. But I think it's really important that we address both sides, right? Volatility is inherent in the market, and I think it can be something that we embrace, we take advantage of in terms of taking profits in areas that have outperformed for us, maybe some of the select tech or some of the select more in vogue areas that we've seen of late that have been very interesting or very buoyant in terms of running up. Some of that Reddick trade, if you're familiar with what I'm talking about. But let's go ahead and jump in. So again, Jim Paulson of the Loophole Group put out just a great little article of February 16th. And it is basically in a market with so many puts, why not buy a call? So we're going to cover a couple different areas. We're going to look at a policy put and what they mean by that. We're going to look at what's called a vaccine put. And I think we probably are getting a good idea of what that is, right? An earnings per share or EPS revival put. And that is where earnings for corporations are improving. And if earnings improve, what generally happens to stock prices? Generally go up, correct? A no inventory put, meaning we don't have a gluttony of products out there. We are almost what's called a just-in-time inventory chain in the United States, which is actually a positive from the standpoint is that you got to keep running and producing for all these extra needs that we tend to have right now. A savings put, we'll talk about a bubble watch or a wall of worry, meaning what I was talking about. There's a lot of pessimism still out there. And maybe when everyone's pessimistic, or well, the majority, maybe we need to be thinking the other side of that, correct? A dry powder put, and we'll conclude the day with a low yield put. So if we go ahead and jump in, Jim and his team are talking about, first off, policy put. So in 2020, policy stimulus as a percentage of gross domestic product, that's GDP, averaged a record high of about 43%. The war against COVID spiked, and now we're seeing the highest amount of policy stimulus, meaning money pumped into our economy than ever before. So interesting to think about it. We have so much money going into our system, it's propping up or supporting. Again, I'm not talking about corrections and pullbacks and pauses in the market. I'm saying we have economic support in this market through just good old-fashioned policy puts, larger than the Great Depression or World War I. Absolutely humongous. Let's go ahead and jump into the vaccine put. Let's think about it. When we get the shot in the arm, animal spirits are going to come out, if they're not already. And we're going to think about traveling again, right? Hopefully. Getting on the cruise ships, getting on the planes, going out to the resorts, seeing family, friends, getting back to maybe some more normality that we got away from in 2020. Now, I kind of believe it's not going to all happen tonight. I think we've created patterns. We've created habits that we're not just going to drop and go completely back, but I think we have to be realistic and say, I think a lot of us probably would be excited about getting in our house and getting back to some normality. So we are going to see a vaccine put. And what we mean by that is if people are going to be going out, they're going to be spending money. If they're spending money, they're supporting the economy, the companies that produce the product, so on and so forth. And that kind of flows right into the EPS revival put that Jim and his team are talking about. And what he means by that, that's earnings per share. Think about it this way, just like the vaccine put. You get the shot in the arm, you feel more comfortable, you're going out, you're buying tickets on airlines, you're traveling on cruises, you're spending more goods to improve or move like we've seen in 2020. And hopefully that continues in 2021 and 2022. Listen, that's more earnings. That's more products being sold, goods being sold. That increases earnings for corporations. And if earnings goes up, what generally happens? Stock prices go up. Again, I'm never speaking in guarantees. I'm just speaking in generality. Yeah, earnings go up, prices go up. Pretty reasonable, correct? So let's jump into the next one. A no inventory put. Let's think about this. And this is what I was talking about before. We are in what's generally called a just-in-time inventory model. And that means as we need goods, they're produced to meet that need. And that keeps costs down, it keeps efficiencies, so on and so forth, right? We're not building and stockpiling all these goods in inventory for a date that may never happen, right? So let's look at Jim and his team's quote on this. Based on a Bloomberg survey of private economists, this year's consensus expectation for real gross domestic product is 4.8. Keep in mind, in February 2020, right before we dipped in March into the pandemic shutdown, we had a gross domestic product hovering about 2.4, and it was slowing a bit. So we have a gross domestic product somewhere around 4.8, which would be the fastest annual growth since 2020. And our guess, or Jim and his team's guess, is that they would not be surprised to see it somewhere around 7-8%. Absolutely huge gross domestic product for a developed nation like the United States. That could flow over to developed Europe. You tend to see emerging markets, China, India, Latin America, might have a higher gross domestic product because they're less mature markets. Even though they might be quite large, they're less than mature than developed Europe and certainly the United States. So imagine that growth rate, what that could do to earnings, what that could do to the market, so on and so forth. However, it is becoming more broadly apparent we have a historic shortage, as we know, in homes. Global scarcity in semiconductors. We're seeing, and I just took my car in today to go get some work done this morning, and I was asking the dealer, like, hey, how is things going here with the sale of the cars? He goes, we have the smallest amount of inventory we've had than he could even recall, and the biggest issue is semiconductors. Semiconductors going into the electronics in cars. If they're not there, we aren't be able to produce the inventory, the cars to go to the dealerships to be sold. Kind of get where I'm going with, right? And then also think about shipping containers. We're having so many things being shipped. We have a shortage. We don't have an oversupply of shipping containers. Probably a lot of things that we just don't think about. So think about all that inventory that now needs to be built up for the demand that's there. Many more goods sold. Again, my calendar popped up. Hit it if you'd like. If you're an existing client, fantastic. We're always here to talk to you about anything that's important to you. You know we're very proactive. We reach out to you. If you're new to Wickham, great. Hit the calendar. We'd love to talk to you about what's important to you. Let's go ahead and go a little bit further. So let's think about the savings put. So when we talk about savings put, we're talking about a contemporary savings put is unprecedented. We're talking about measured on a monthly basis. We're having a mass amount of savings. So if we're thinking about it peaked last year somewhere around 34% in April. It is still 13.7% higher than almost any other time except for 2020. Let's think about this. We haven't been traveling and we haven't been spending as much. We're getting stimulus checks. Businesses, personal, this money is going into our bank account. What do we think we're going to do? Or what is the odds that we're going to do when things open back up, right? Things tend to repeat itself. We'll probably increase our spending. We'll travel a little bit more. We're going to go buy a little bit of this because we feel better, not just physically, but also about our personal situation and the economy, all right? So that's your savings put. Let's think about a bubble watch of the wall of worry put. I think this one is really interesting because I think what often is confused is that we get snippets, right, of news, or we get snippets of information, and then we paint the market with a broad brush. And what I mean by that is, you hear the Reddit trade, you see these stocks that are just up 2, 3, 4, 500% in a short amount of time, days, weeks, months, and you got to think, well, this market is just incredibly overpriced, and everyone is just buying anything willy-nilly. Well, that's not necessarily true. Are there certain sides of the market that are overpriced and have bubbles? Absolutely. And that's where we would say, you need to monitor your situation. I know we work with you. If you're a client of ours and we're monitoring yours, take profits. It's okay. That's a case by case. You need to manage your own personal situation, but don't be afraid to pay yourself a little bit. You never really make money until you take it. Doesn't mean we're saying run for the hills. It just means get back to your good old-fashioned diversification, allocation, and make sure it's part of the plan, right? So let's get back to the wall of worry. When everyone is thinking one direction, what do we want to start thinking? Maybe the other. I kind of use it as think about the ship. If everyone, and there's a ship in the ocean, everyone gets on one side of the ship, what happens? It tilts, right? So maybe we want to start thinking about the other side of the ship. And that's where you're seeing really of late, with the reopening stocks, the travel, airlines, if you paid attention over the last couple of weeks. We're really seeing those areas start popping up. Be mindful, there's reasons they still could be a little overpriced. It doesn't mean that when the economy reopens, everyone's going to get back to normal. They're going to throw caution to the wind and money into the wind and buy everything. Not necessarily is it going to happen that aggressive. So let's all take everything that Jim and his team's talking about with a little bit of grain of salt. Then we look at a dry powder put. I think this one's pretty interesting. Investors have been piling into bonds and ETFs over the last 3 years, while pretty much shunning stocks and stock funds and stock ETFs. Even though the markets are hitting new highs, we still have a mass amount of funds that have gone into very conservative vehicles to preserve, protect, or generate income. Nothing wrong with that. That can be a part of a good, balanced, diversified portfolio to mitigate risk. You've got to evaluate your situation. But when too much is on one side, and let's think about it, in bond funds, in fixed income equivalent areas, when interest rates start rising, and they are on the 10-year treasury, when interest rates start rising, that can negatively affect bond principal values of bonds that are already issued and fixed income equivalents. All right. It's a borrowing cost, or the opportunity cost is greater for you to not have money in those to buy something that has a higher yield because it's gone up. Need more explanation on that? Happy to have a call with you or address that in the Q&A in just a minute. But that's what we mean, or that's what Jim and his team means by the dry powder. You can see really people that have overexposure to some of those areas say, hey, listen, I'm not making the returns that I see others are making in stock-oriented investments. I want to take my money from here, or a portion, and start shifting it back over. Then let's look at the low yield put, the last one on Jim and his team's list. As shown for all months since 1900, this is going back a pretty good ways, right? When bond yields rose from a level below 3%, and we are well below, the U.S. stock market achieved an average annual price gain of 16.8% and increased 68% of those months. But for comparison, when yields began from a higher point, so above 3%, The stock market experienced essentially flat performance with monthly gains of only 52% of the time. So currently, let's look at where we're at. The yield put is rare. The 10-year bond yield has been below 3% only 25% of the time since 1990. So we're well below the 3. All right. Again, these aren't things that I would say are absolutely going to happen. But I think they're things we need to be mindful of, as well as there's negatives out there, and there's certainly plenty of them. There can be positives out there. And what Jim and his team has highlighted in terms of some of the puts. Lastly, I kind of want to jump into just some little tax tips as we run into tax time here on April 15th. Let's think about it. If you're a small business owner and you do not have a retirement plan for your business, like a 401k, a simple plan, or even a SEP plan, or if you have a SEP plan, let's think about making contributions to those. I know many of our clients are small business owners, and let's think about making contributions to those. It's the lesser of 25% of your compensation, or $57,000. And if you file an extension for your business return, that'll give you up to October to max out that SEP. What we mean by that is you make $100,000, you put $10,000 in, you're only showing Uncle Sam or the government in terms of taxation or taxable income of $90,000. All right. Then we want to think about just taking advantage of employer plans. If you have an employer plan at work, take advantage of it. Look back at your situation. You may not have a lot more to do for 2020 now that it's 2021, but we want to think about maxing to the match. So what we mean by that is if you got a plan, take advantage of it, potentially. But if they have a match, meaning for every dollar you put in, they put in 50 cents on a dollar or a dollar for dollar up to a certain amount, usually somewhere between 3 and 6%. If they're doing that, max that out. Take the employer's money all day long. Best advice I can give you. All right. What you do above and beyond that, let's have a conversation. That's a question mark. Now let's think about maxing out your IRAs or your Roths. Now, we say if eligible. Roths do not give you deductions on your taxes, but it does start that time frame from 5 years from the first contribution, and you're over 59 and a half, all that money will come out tax-free down the road. So you don't get a deduction on your taxes today, but you start that time or that clock, if you might. With an IRA, if eligible, if you're not contributing to an employer plan, you may have the opportunity to do an IRA. Or if you don't have an employer plan where you work, if you're a small business owner, you can put into an IRA. You make $100,000, you put in $6,000 or $7,000, depending if you're under 50 or over 50. Hey, what? You're showing $93,000 odd dollars. So just little tips and tricks to save a little bit as we're getting real close to filing your taxes if you haven't right now. Let's try to max those out. Maximize HSA contributions. What a great way to do that. You can use that to help subsidize any long-term care needs that you might need, not long-term care insurance, but long-term care needs down the road. Now, anytime we're talking about tax tips and whatnot, we're not CPAs. Talk to your tax advisor. If you need us to recommend something, we're certainly happy to give you a couple names, but do your own homework, interview them, make sure you like them, and they're going to accomplish your goals and objectives or what you need accomplished. Okay. Again, we're not CPAs, but this is just some basic tax advice as we're leading into tax time. Lastly, let's hit on a couple things that I'm always going to bring up at every call. You should always have a balanced approach. You should always have a diversified portfolio that's allocated properly. And if you don't know what I mean by that, hit my calendar. It's right there. I'll talk to you about any one of my team members. We'll talk to you about, we can inspect what you expect. If you're a client, you've already sat down with us. We preach it, teach it, and practice it all the time. So balanced approach, diversification, allocation, really important because I am expecting, and you've got to expect. I don't know if it's going to be 5%, 20%, 50%. I think there's some reasonable expectation for somewhere between 5 to 20%. Again, there's no crystal ball, but I think we have to expect volatility. When things have been going so well, for whatever reason, people just decide to take profits. That's not necessarily a bad thing. And I don't know if it'd be that bad if we just have a little bit of a pause for this market to digest the goodness that we've been pricing in, right? as we prepare for a longer bull market that might go through 2021, 2022, and potentially on. We'll just have to see how that shakes out. And then always manage to your risk score. I kind of put it this way. Don't get too far over your skis, right? Don't take on more risk than you're comfortable taking. Again, if you're new to us, you're not a part of a Wickham client, this is going to be a new term. If you're a Wickham client, you know what I'm talking about. We manage to risk here. And that is, we want you to maximize the risk you're comfortable taking based on goals, objectives, your time horizon. But we don't want you to take any more risk than you have to take to achieve what you need to achieve. And we do that through pretty advanced calculations and monitoring. All right. So don't take on more risk than you need to take. And we can assist you with monitoring that going forward. That's pretty much all I have today. I do want to leave a little bit of time here for questions, answers. Again, if I don't know the answer, I'm a big boy. I'll let you know that, and I'll reach out to you after the call. But Jeremy, can you go ahead and let's turn this over to a little Q&A.
Hey, Graham, thanks so much. It looks like we did have a couple questions come in. The first one is, when considering historical trends, do you consider that the future will not be similar but different? An example could be stocks, ETFs, and bonds.
Well, let's look at it this way. I think, I might have said this before many times, I think the past leaves clues, and there is some rhythm and pattern to it. Does it ever exactly repeat itself? And I'm hoping I'm addressing the question correctly. Does it ever repeat itself exactly? Absolutely not. But it does leave clues, and it does have some rhythm. So I think we can look at the past to kind of give us some idea, but I wouldn't depend on the past to give us absolutes. I hope that answered your question.
Next one, can you briefly explain the difference in a put and a call?
When you're talking about puts and calls, you're talking about more options, and that's not what we're talking about today. What Jim and his team is talking about is kind of a buoy or support, a put, a buoy or a support, a call, expectation that something's going to go higher. But in terms of options, we're not the experts to talk about that. I would leave that to someone that is in terms of options.
All right. The next one we got, should we consider being less risky and changing our risk score this year, given some expected volatility, or leave it alone in more for the long haul?
Well, it's a great question, and we get that all the time. This is why we set and plan portfolios ahead of time, right? I've used the analogy in the past about thinking about investing like a war, right? This is a marathon, not a sprint, all right? A sprint would be you have a goal that's 1 year out, 2 years out, 3 years out, right? That's a sprint. You're running really fast, or you're trying to hit something in the shorter run. But really, for all of us, for the most part, if we're thinking about retirement or end-of-life planning, all this good stuff I know we talk to you all about and we work with you on, you're thinking about a marathon. So think about the war. When you're thinking about the war of investing, the war for your future, we don't get caught up in these little battles. So I don't want you to go in and change your risk score because we're getting some short-term volatility. If we've done our job right and we got an awesome partnership with you, and I think we do with every single one of our clients, we're truly blessed, then we've done the homework ahead of time. We've managed the risk score to know what the volatility that we're expecting on the upside and downside. You're comfortable with it. It aligns with your goals and objectives, and we're comfortable with it. And if we checked all those boxes, you're in a good spot. So the answer is no, generally.
I had another one come in. It says they hear the term wealth management all the time. What is that?
That's a great question. And that's something that I think we try to really practice here, not just in the classes and courses we teach, because we teach in local schools and universities, multi-day retirement planning, investment planning courses. Think about holistic. It's a holistic approach to managing what's important to you through all stages of your life. So it's not just about investments, which is super important, right? The implementation, the allocation, the diversification, how to grow or generate. But we want to think about retirement planning, right? What's the cash flow? What's coming and going? Where are you going to get your income to supplement that retirement? We want to think about maybe a third component. We want to think about taxation. How can you keep more of what you earn instead of paying out or giving away, right? Sometimes we do, and we don't even think about it in terms of taxation or positioning of assets and where they're going to be treated best. A couple others that we think about a lot is estate planning. Estate planning, a lot of individuals, and we get it all the time in class or we're meeting with new clients, they think about estate planning as like end of life planning, like wills and trusts. That is one component of estate planning. Estate planning is about managing what's important to you and the people you care about or things you care about while you're alive and then after you pass. So maybe think about it from that way. And then we kind of wrap everything up in a good old risk management package. If you don't know how fast you're comfortable driving, you don't know how quick you're going to get there, right? If you don't have a map, how do you know where you're going? It's that kind of thing. So we want to think about risk management. How do we protect what's important to you? How do we maximize that risk score for you, but don't take any more risk that you're comfortable taking to achieve that? That would be with investments. You also want to think about your disability income while you're working, not when you're retired. Long-term care after you retire. Right? Then we want to think about life insurance. Does that play a role? We want to think about auto home coverage. You want to make sure those are in place because trust me, there's attorneys out there. If you don't have the right coverage because you're trying to save a dollar, you just didn't know, they're going to come after you. So we want to think about that. If you own a business, we're going to think about your workers' comp, your general liability, your coverage for your business. And we want to make sure they're all cohesive. They're all moving in the same direction. So I hope that answered that question.
Graham, it doesn't look like we have any more questions at this time.
Yeah, that's great. Well, listen, I appreciate everyone for being on the call. I hope you join us next month. The last Wednesday of every month is when we have these calls. My calendar is still hanging there. If you don't feel comfortable hitting the calendar, just give my office a call, email us. We'll sit down. I'll sit down, any one of my team, and go over any questions that you have. But I hope you all have a great day. Keep in mind, volatility is just a part of investing. If you need us, reach out. Have a great afternoon.